The world center for the economic gravity has been shifting in an eastward direction for the decade due to the rapid growth in Indo-Pacific region that caused the trade pattern to be shift as it moves towards it. In a recent report published and projected that the India would leapfrog to the third place by 2050 in the ranking of world largest economies, just behind China and the US, with a share of 6.8% in global GDP. With a growing middle class and its rising discretionary spending, India will become the world's third largest importer by 2050 with a share of 5.9% of global import, right behind China and the US. The projected ranking among the world economies at present, India is ranked 8th among the largest importing nation with a 2.8% import share, and is said to become the fourth largest importer by 2030 already. It's estimated, predicted within 10 years. The US and the United Nations group, along with the European Union's share of those import sector is expected to decline out to 2030 as the growing purchasing power of Asia's middle class account for a rising share of those global import demand. It's particularly marked at the food, travel, hospitality, digital services sectors where the larger and increasingly the wealthy population in the Indo-Pacific region are expected to boom, and it consumes the goods and services more than ever. Its unprecedented demand has risen in those Indo-Pacific region, including the Southeast Asia, that the latest global trade outlook issues by the UK Department of International Trade is suggested. The world center of economic gravity has been shifted in Indo-Pacific, and that shift is moved the pattern between 2019 to 2050, approximately 3 decades long tenure. 56% of the global growth is expected to come from the Indo-Pacific, compared to the quota from the European Union and the North America combined. The growth within the Indo-Pacific is also expected to rebalance over the time frame, that with the South Asia's contribution that is mainly driven by India and China is rising tremendously in the future years, and China is the major driver of this eastward economic shift, as it is expected to become the world's largest economy by 2030. The China already displaced the US in the purchasing power parity terms, with account for the differences in the local prices in the mid 2010. But based on market exchange rates, which are most relevant for the trade, and the change is expected to happen around 2030. Basically, at that point, both the countries will account for around 22% of global GDP. The report projected that India would leapfrog to the third place by 2050 in the ranking of the largest economies, after the China and US, with the third positions with a share of 6.8%. Currently, India is ranked 5th in the size of world economies with a share of approximately 3.3%. India's GDP is projected to cross the Germany by 2030 to become the fourth largest economy. The role of those emerging economies in the trading system will rise over the time, consistent with their growing weight in the global economy sector. The 7 largest emerging economies currently in globally, that China, India, Brazil, Russia, Indonesia, Mexico, and Turkey, that are all projected to equal the G7's share of global import demand by 2050, and the 7 richest countries of the world like Canada, France, Germany, Italy, Japan, UK, and US, all part of the G7 grouping, are expected to compete with those region-specific control and shift the consumer markets and demand from south, and it's shifted to the European Union group to the South Asia Pacific, Indo-Pacific areas where the Asia's middle class peoples are bring those demands back to the Asian areas. Is US and European Union's share of most import sector is expected to decline to 2030 as the growing purchasing power of Asia's middle class account for rising share of global import is demand. The report further revealed that the world's center of economic gravity has been shifting for a decades, causing trade pattern to shift as it moves. Basically, the food, travel, hospitality, digital service sectors were the largest, and the increasing wealthy population in Indo-Pacific are expected to consume more discretionary goods and services. And based on market exchange rates, which are more relevant for the trade, the first 2 decades of this century, labor productivity growth, that is the main driver of those higher living standard, was 3 times faster on average across the 7 largest emerging economies than across the G7 group. That is important parameter also added that G7 share of global GDP fell from 65% in 20,000 years to the 46% in 2020. In 2000, 65% to 46% in 2020. That means it's a decline of 20% in 20 years, while the emerging economy share rose from 11% to 28%. Over the next 30 years, the labor productivity also growth in growth sector across the E7 is expected to grow at roughly twice at the rate of G7, with the E7 emerging economies overtaking the G7 in economic size during the 2030 to be expected. And the shift on this economic power is likely to mean the emerging economies will play a growing role in the global trading system. It is forewarned that the emerging economies have the significant catch-up potential. They also face the major challenges, including the need to shift the imitation to the innovation that escape the middle income trap, tackle those indebtedness, and the rebound from the pandemic recently occurred globally. That's all for now. Thanks for watching. See you in the next video.